One of the hardest things to do in investing is to sit through a period where you think you're wrong, or where the strategy that you believe in or that you're following is underperforming or not performing. And I often think about why certain strategies work while others don't. And though I bash this strategy often, one of the best strategies is to buy and hold. I mean, there are long periods of time where just buying and holding the stock market is going to work, right? I mean, if you buy and hold the stock market and say put $1,000 a month into the stock market and you reinvest your dividends, okay, you're going to be in the top 1 or 2% over any 10-year period, over all investors, all investments. You literally will be at the top for almost doing nothing. Now, one of the reasons why buy and hold works, or some people say buy and forget, is because there are periods of time where buy and hold absolutely doesn't work. And there was a 2.5-year period at the beginning of this century from, depending on which index you're measuring, but basically from March of 2000 to the end of 2002. It was a very painful period for anyone who bought and held the S&P 500. It was exceptionally painful for anyone who bought and held the NASDAQ. They lost an incredible amount, 70%, depending on how they were positioned in it, 70%. And then in 2008, there was an 18-month period where the S&P itself fell almost 60%. But during those other periods, buy and hold actually works. It takes no effort, takes no attention, and the market's going up 80% of the time anyway. It's just that 20% that just absolutely kills you. But all things being equal, buy and hold actually beats do it yourself. Buy and hold beats big box advisors. Buy and hold beats conventional independent advisors. Buy and hold beats newsletters. And that was my foundation of building market probability. MPX2 was you can actually beat the market by being the market first. And it's how you are the market that can help you. And it's how do you avoid some of those larger corrections, right? Even Warren Buffett, some who consider him the best investor of the last century or half century, he lost his clients 50+% of their money in 2008. He lost his clients 50% of their money again in 2000. And this is the best investor. Now, no one noticed this because as he was losing half of his clients' money, so were the other big box. Well, he's not a big box advisor, but so were big box advisors and conventional independent advisors. So there are periods of time where even strategies that do work appear like they're not working. And it's in that keeps them working. And I'm not trying to go all zen on you here. But if you think you're going to follow a strategy that always works, you are mistaken. What you want to do is find a strategy that when it's not working or appears like it's not working, what does it do when it's quote unquote working again? Like how does it make up for that opportunity loss? And that was one of the things that I wanted to create with market probability. I knew there were going to be periods of time where it underperformed the stock market. Of course. So the question was, well, when we go back into whatever mode we should go into, what does it do to make up for that opportunity loss? And that was one of the things I wanted to make sure that was built into market probability. Hey everybody, this is RC Peck, and this is my weekend podcast. And the theme for this weekend is, did I mess up? As I mentioned, I think it was in last week's podcast, that opportunity costs the brain or feels so painful for the brain than actually losing money. And people would actually rather lose money than have opportunity loss. And so there are periods of time for all investors when they buy an individual stock or an individual sector, or they buy the market, whatever strategy they're following. And let me be clear, everybody is following a strategy from I trust and like my broker to I hope it works out. Whatever it is, or you name it, or have not named it yet, everyone is following a strategy. And there are periods where everyone feels or goes through a period of, did I mess up? Now, the good sign is knowing when you actually did mess up, meaning having stop losses, having a strategy, having a checklist, knowing when you actually are wrong, not just emotionally feeling wrong. So with that, I want to show you a handful of price charts with what some of the major markets are really up against or in right now. And so what I want to talk about first is what they're up against. So this price chart right here is the NASDAQ, and it goes back to 1999. And you can see right now with the circle that the NASDAQ is at its 2000 high. Now, I did not zoom in because I wanted to give you a big picture to just show you, hey, this came up to its 2000 high, has corrected, and is wanting to kind of knock on that door again. Is it going to go higher? Is it not going to go higher? I don't know yet. But on the top, or what's right above the NASDAQ, is this 15-year resistance or ceiling that it's going to want to try to get above. At the same time, you've got the German stock exchange, and Germany is one of the largest economic engines. Well, it's the largest economic engine of Europe, and it's one of the largest economic engines on the planet. And here, Germany is at its 161.8 Fibonacci retracement. All that means is it's very common after a market, an index, a stock makes a 100% move, in this case from the bottom of 2003 to the top of 2007. Look at that, it did a triple top there, if you can see that. Then the measured move it often wants to do once it breaks that resistance is go another 61.8%. And it did that, and it fell hard down to this other support line. And so now the German stock exchange is trying to figure out, do I go higher? Do I break down below? But this is going on at the same time the NASDAQ is figuring the same thing out. Then you've got the S&P 500 that has a very similar measure move from what we just saw with the German stock exchange. Now from this, we're just measuring it from the high of 2008 to the low of 2009. Actually, that's the high of 2007. And you can see the measured move above that, again, it wants to move 61.8% of the last major move. And that's what's above it. It is strong resistance above the S&P right now, and it has corrected down. The question is, can the central bankers push it higher above that very strong resistance? We're going to find out. We don't know yet, but we're going to find out soon enough. At the same time that the German stock exchange and the NASDAQ and the S&P 500 is hitting this resistance, the Dow Jones is hitting it too. Now, these are all very different types of stock markets. The Dow Jones is, generally speaking, the 30 largest stocks in the U.S. And again, if you look at its measured move above its last major 100% move, it's doing that 61.8% above the last, and it has the same resistance. So what we have right now is this kind of this in concert move of German stock exchange, the French stock exchange, let's just call it the European stock exchange, the US stock exchange. Those two together represent about half the planet's wealth. And they have a big resistance, but then at the same time, they have all this support under them. So look at this right here. And I know there's a lot of data on here, so stick with me. So here, right here, we're just looking at the Dow Jones. Now I'm just showing this to you slightly different. This is the same information, but notice how it's in this upward channel, and it did a 38% correction now. 38.2% is another Fibonacci retracement, just like a 161.2 is an extension, is a Fibonacci extension. They're Fibonacci numbers. So on the top, you've got the resistance. On the bottom, you've got support. Both of them are very strong, and both of them are happening in concert with other indices around the world. This is the French stock market. Again, very similar. Of its last major move, it has fallen off. It is still in this 5-year upward trend at its 38% retracement. And if, like me saying retracement and 38%, if that's confusing, just know you've got a bottom support and you've got a top resistance. And there's going to be a battling figuring out which way it's going to go. And then over here, you have the London Stock Exchange. Again, same things happening. You got resistance, you got support down here. Down below, we have the Chinese stock market. Same thing, resistance, support down here. S&P 500, which probably looks the best out of all of them. Again, we're looking at strong resistance up here and stronger support down here. And then lastly, you've got the German stock exchange with the resistance at the top and the support at the bottom. The point of me showing this to you is we don't know yet what's going to happen. I see support at the bottom. I see resistance on top. And many of these markets, I just showed you really I don't have Japan on here, but I have 3 of the 4 largest economies on the planet represented here. So everything is moving in concert. If one thing moves, they're all going to move. Another reason why diversification is really dead and is actually a myth. If one of them goes, they all go. We have never been more interconnected as an investment planet, I guess, than we have today. One quick crazy fact that you just try to comprehend what I'm about to say to you. The Japanese government owns more than 50% of all the Japanese ETFs in Japan. They've been buying so much of the Japanese stock market through Japanese ETFs. They own more than half of all the shares in all the Japanese ETFs, or the ETFs that represent the Japanese stock market. That is insane. Like, how does that end? How does that end well for Japan? Or that Japan is just operating so badly that the government now, other than crushing its currency, is just going out and just saying, we're just going to buy the stock market. I mean, this is insanity. I mean, this is crazy. There's no way. I mean, the black swan is that this all resolves itself somehow with triple the amount of debt we have from 2008. Somehow that will resolve itself. But I'm not sure how it's going to resolve itself. There's something like 2.6 trillion euros that are currently in negative interest rate bearing bonds in Europe. 2.6 trillion. That is a lot of money at a negative interest rate. Now, of course, things can get worse. That could be 3 trillion, 4 trillion, 5 trillion euros worth in negative interest rate bonds. I mean, sooner or later it will resolve itself. But right now we really are in some very interesting times. And from the price charts I just showed you, you could see that we have an upward resistance and a downward support right now. And I'll be watching it to see which way it resolves. And for all of you that are following a strategy consciously, know that even the best strategies have periods where they look like they're not working. Or when you buy a stock, there are periods where it's not like if you just buy a stock, it starts going up. So the key is there are periods where it looks like, did I mess up? Am I doing this right? And the key is to actually have a stop loss that says to you, okay, now I actually know things are moving against me and it's just not emotionally. And when things do get quote unquote turned around, have a part of your strategy that can make up for that opportunity loss. So what is the takeaway? It should have said everybody's strategy, but it says everybody's strategy. Everybody's strategy has periods of looking like it doesn't work. And that's why those strategies keep working. Now, this could be a nuanced thing because there are some strategies that actually do not work. But even the ones that do work, there are periods where one would say, or one could look at them and say, yep, that did not work. Thanks, everybody, for being in my world. This is just another step in helping you protect your future and protect your portfolio. Until next time, this is RC Peck. Hey, everybody, I'm so glad to have you in my world. And any way I can help you, please let me know. I am sending out the diversification myth training again. We got rave reviews from it before. Like I said to you before, it's probably one of my best trainings that I ever have put together. I put a lot of thought into it to show you exactly why not only are the big box advisors against you, conventional independent advisors against you, even the newsletter, the investment newsletter industry cannot help you. And I go so far, appropriately speaking, of course, how you can protect yourself from, or protect your money from your lesser self, We all have a lesser self. That's the part that only ever seems to speak up in hindsight. How do you protect your money from your lesser self? The diversification myth training answers that, along with what is the best way to protect and grow your money.